Today we are going to do a tool called investment criteria. This tool is very useful when you have a significant investment to make and you're asking yourself, should I make that investment? And the investment could be in maybe buying a company, it could be in investing in a new product, investing in a new plant, investing in new machinery, investing in a new office in some other city, investments of various sorts. This tool gives you a very structured way of thinking about, should I make that investment? First of all, the very first question you have to ask is, will I make money in this investment? How do you tell if you make money? You look at the return on investment. What return will I get on this investment? If I make this investment, over time, will I make money? And the best way to do that, by the way, is by a calculation called net present value of future cash flow. In other words, I make the investment now, cash goes out now in the investment, and over time, I have new revenue that comes in, and that produces new cash. Cash comes back in over time. Now, with discounting the cash for time value of money at whatever rate of discount you wish to have, you say cash going out now, cash coming in over time, will the net present value of that future cash flow, would it be positive at the discount rate I have chosen to use? That is called return on investment. Unless there is a positive return on investment, you should not be making the investment. People often like to convince themselves there are other subjective reasons why we make this investment. Let me tell you, those subjective reasons often evaporate into vapor very quickly. Make sure you have a positive return on investment. But that's only one of 4 tests you have to make to decide whether I should make that investment. The second test is cash flow. Do I have the access to cash so that I can make the investment now, I'm out of cash, and I can wait for the cash to come in over many years? Do I have the cash capacity to make that investment? If by making that investment, my cash balance falls so low that my business goes bankrupt, then there was no point in having made that investment. So even though the investment might have a positive return, you might not have the cash capacity to make that investment. That is the second test you should make. You have to have the cash capacity to make that investment. Third test is, do I have the luxury in my P&L, in my income statement, in my profit and loss statement? Do I have the luxury to make that investment? Now, this is a much bigger deal for public companies, but it is also an important item for private companies. If you have a bank loan, you have covenants on the bank loan. You have certain ratios that you have to maintain without violating covenants. If you make an investment, accounting requirements will require you to take a charge in today's income statement that you will only realize at future time. So today's income statement is adversely impacted by that investment, and therefore your P&L looks bad. Result of that would be the investors would look at your P&L and you would have to explain to them, it's because I've made an investment. Your bank is going to look at that P&L and say these ratios are going awry. Can you afford the adverse impact on your P&L? You have to ask yourself that question. So you have to ask yourself, do I get a return on my investment? Do I have the cash capacity to make that investment? Can my P&L afford the impact? And last of all, is my risk diversified? Are my investments adequately distributed that they're not all eggs in one basket? A related tool is called analysis of investment portfolio, Take a look at that tool. It helps you identify if your risk is diversified. You do not want to make an investment with the same risk over and over again. For example, you would not want to make an investment on one kind of product many times, or spreading into more geographies all at one time, or investing in one client multiple times, because then risk is concentrated. So you have to ask yourself, is your risk diversified? So four dimensions in which you must examine your investment is, am I getting a return on that investment, and how much? Do I have the cash capacity to make that investment? Can my P&L afford the impact, and is my risk diversified? As you make large investments in your company, don't use the seat of your pants or your gut feeling to decide if it is right. Be a bit more analytical, intentional about the investment you make. Follow the investment criteria.